Can you imagine not just surviving but thriving in an era of soaring inflation? What if I told you that even during high inflation, you could find ways to grow your wealth? Welcome to 2024, where inflation has hit a notable 3.1%, making it critical to rethink how we manage and grow our money. Inspired by Warren Buffett's time-tested strategies, we will explore how you can make inflation work for you instead of against you. So, are you ready to turn the tables on inflation? Let's dive in, comparing inflation periods, past and present. How does the current inflationary period compare to those of the 1970s and 1980s? The economic landscape of 2024, marked by a 3.1% inflation rate, offers unique challenges and opportunities. Just like past inflation periods, American businesses and citizens are seeking ways to reduce its negative impacts. Warren Buffett has long emphasized the importance of developing skills that people will pay for in the future, regardless of the unit of exchange. This advice holds true across different inflation periods. For instance, during the high inflation of the 1970s and 1980s, businesses faced similar challenges with rising costs and the need for pricing power. In our current climate, it's essential to recognize how much prices have increased. For 2 years, prices have been steadily rising, reflecting the ongoing inflationary pressures. By understanding these historical parallels, we can better prepare for the future and adopt strategies that have proven effective over time. The danger of savings during inflation. Have you ever considered how inflation affects your savings? Holding on to cash during high inflation can be detrimental. Warren Buffett has consistently warned against the hidden costs of keeping money in savings accounts. Imagine earning interest on your savings that fails to keep up with a 3.1% inflation rate. Essentially, you are losing money. This erosion of purchasing power is what Buffett refers to as a wealth tax. While your cash balance remains the same, its real value, the amount it can buy, decreases over time. Buffett's solution is to invest in assets that outpace inflation. This involves looking beyond traditional savings and exploring opportunities in stocks, real estate, and inflation-protected securities. By doing so, you can ensure that your money is not only preserved, but also grows in value. Identifying good and bad investments. In an inflationary climate like 2024, understanding which investments to avoid is crucial. Buffett's decades of experience highlight the risks of certain types of investments during high inflation. Let's explore these in more detail. Number 1. Fixed income securities with long maturities. During inflation, interest rates rise, reducing the value of existing bonds with lower rates. Historical data shows that long-term government bonds performed poorly during high inflation periods, such as the 1970s. Number 2. Speculative assets. Chasing high returns on speculative investments, like certain cryptocurrencies or volatile stocks, is risky. Buffett advises focusing on assets with intrinsic value, those that generate consistent earnings. Number 3. Commodities. While commodities can offer short-term gains, they don't produce income or dividends. Over the long term, commodities haven't significantly outperformed inflation. Number 4. Real estate. Property values may rise with inflation, but so do maintenance costs. It's essential to analyze a property's income-generating potential and the impact of rising costs. Number 5. Businesses with high fixed costs. Companies with high fixed costs and little pricing power struggle during inflation. These businesses can't pass on increased costs to consumers, squeezing their profit margins. By avoiding these risky investments, you can better protect your wealth during inflationary periods. Now, before moving on, make sure to like and subscribe to our channel for more informative content. Getting back to the topic, embracing dividend-paying stocks. One of the most effective strategies during economic downturns is investing in dividend-paying stocks. This approach, endorsed by Warren Buffett, offers a blend of steady income and potential for capital growth. Here's why this strategy is effective. Steady income stream. Dividends are payments made by companies to their shareholders out of their profits. In times of economic downturn, having a consistent income stream from dividends can be a financial lifeline. It provides a cushion against market volatility and can help sustain your finances when other sources of income might be under pressure. Regular dividend payments can also offer peace of mind. knowing that you have a reliable source of income even when the broader market is turbulent. Capital appreciation. Besides providing regular income, dividend-paying stocks also offer the potential for capital growth. Companies that consistently pay dividends are often well-established and financially stable. Investing in these companies can lead to capital appreciation over time as the value of the stock increases. This dual benefit of earning dividends and potential price appreciation makes dividend-paying stocks an attractive option for building long-term wealth, particularly during inflationary periods when other investments may falter. Compounding effect. Reinvesting the dividends you receive can lead to compounding growth. By using your dividends to purchase more shares, you increase your potential future dividend earnings, creating a snowball effect that can significantly boost your investment over time. This compounding effect means that your initial investment grows not just through the appreciation of the stock price, but also through the reinvested dividends, enhancing your overall returns and helping to combat the erosive effects of inflation. Risk reduction. Diversifying your portfolio with dividend-paying stocks can help reduce risk. These stocks are typically less volatile than non-dividend-paying stocks, providing a more stable investment option during economic downturns. A study by Hartford Funds showed that over a 50-year period, dividends contributed to approximately 40% of the total equity market returns. This highlights the significant role that dividend-paying stocks can play in an investment strategy, offering stability and consistent returns even in uncertain economic times. Studies have shown that dividends contribute significantly to total equity market returns, highlighting their importance in an investment strategy. Buffett's top dividend picks for 2024. If you're looking for dividend-paying stocks in 2024, consider Warren Buffett's top picks. These companies have demonstrated financial stability and consistent dividend growth. Number 1. Visa. Known for its economic moat and resilience, Visa benefits from the increasing shift towards digital payments. Its strong market position and history of steady dividend growth make it a reliable choice. Number 2. American Express. With a premium brand and loyal customer base, American Express has maintained and grown its dividend payouts. Its focus on high-spending cardholders provides a stable income stream. Number 3. D.R. Horton. This leading home construction company benefits from the growing U.S. housing market. Its strategic focus on affordable homes positions it well for dividend growth. Number 4. Coca-Cola. A longtime favorite of Buffett, Coca-Cola's global brand strength and diversified product portfolio contribute to its steady financial performance and commitment to dividend growth. These companies are well positioned to navigate economic cycles, making them ideal candidates for dividend investment in 2024. Warren Buffett's investment strategies offer valuable insights for thriving during 2024's inflationary environment and beyond. From avoiding risky investments to embracing dividend-paying stocks, Buffett's approach can help you navigate economic uncertainty with confidence. What are your thoughts on these strategies? Share your insights and investment plans in the comments below. And if you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Thank you for watching, and until next time, keep investing smartly.